Okay, good afternoon, everyone. My name is Maggie Bolt with the Poirier Group, and I'd like to welcome everyone to our webinar, Operational Due Diligence in Private Equity, how to maximize deal value through operational optimization. The Poirier Group is a management consulting firm focused on strategy execution, operational efficiency, and sustainable business transformations for national and international clients across many sectors. We provide insights and experience into process improvements that can maximize efficiencies to save companies money and implementing those changes for sustainability. We've been in business for about 15 years now, helping companies achieve high performance with sustainable results. Our firm has recently been recognized as one of Canada's most admired corporate cultures by Waterstone Human Capital, as Small Business Professionals Company of the Year by the Stevie International Business Awards, and by Vault.com as a top boutique consulting firm in North America. Before introducing our speakers, I'll just cover some general housekeeping. A quick reminder, this session is being recorded and will be sent to you after the webinar. And if you have any questions in for our speakers, please type them in the question window in your bottom right-hand side, and we'll do our best to answer them throughout the webinar. On behalf of TPG, I'd like to welcome our speakers. Samantha Horn is a partner in the mergers and acquisitions and private equity groups at Stikeman Elliott. Her practice focuses on mergers and acquisitions and private equity and venture capital financing, including investments and buyouts. Samantha received the Women's Executive Network's Canada's Most Powerful Women Top 100 Award in the Hall of Fame category in 2017 and the KPMG's professional category 3 times, recognizing her significant impact to the legal profession and her leadership role within the firm. Samantha is a fellow of the American Bar Association and is a past chair of the Private Equity and Venture Capital Committee of the American Bar Association's Business Law Section. Samantha is a founding and an executive member of the Canadian Women in Private Equity Committee of the Canadian Venture Capital and Private Equity Association, and a member of the Women in Capital Markets and Women's Association of Venture and Equity. Samantha is also the Vice Chair of Governance in the Association for Corporate Growth of ACG Toronto. She is a frequent speaker on various panels and also sits on the board of directors at Halton Healthcare, comprising the Oakville, Milton, and Georgetown hospitals. Mike Lank is a Senior Managing Director of Operations and Strategy at OMERS Private Equity, having joined in 2006 to build the Operations and Strategy team. Within his role, he works with investment and management teams at OMERS to assess new investments and define and execute value creation priorities. Michael has been actively engaged in a number of current and prior investments in Canada and the US and Europe. Before this, Michael led the VoIP business at TELUS, following a number of other strategy and operations roles. Before TELUS, Mike was with the Boston Consulting Group, leading strategy and operational improvements across industries and geographies. Mike started his career with a private equity boutique, focusing on investments in Mexico and the US. David Poirier is the founder and CEO of the Poirier Group. He provides leadership and oversight acquired from 25 years of successful C-suite experience with major national and international organizations. He creates and executes operational strategies, business transformations, and process improvements that positively impact organizations in the US, Canada, and internationally. He has an ability to create and translate strategic roadmaps into actionable goals and real results. David thrives at running multiple global divisions in complex and ever-challenging business environments and affecting positive cultural shifts that impact bottom-line performance. I'll now hand things over to David as our moderator to kick off our discussion.
Great, thank you very much, Maggie. I appreciate the introductions for everybody. Really excited about today. I think we're going to have a wonderful chat with the panel today, and I think you're thoroughly going to enjoy it. So this has been a crazy time, certainly, if we look at last year. What a roller coaster in mergers and acquisitions, from the focus in the end of the first quarter and in the second quarter of struggling to maintain the existing portfolios and keep them alive and frantically doing what they could, to what ended up being a very busy second half of the year. So in 2020 alone, the total dollars invested was higher than the previous 5-year average, with a lower number of deals. So in a world where so much money is chasing so few deals, PE firms really need to be smart in their acquisitions and focus on creating value beyond their financial statements. Taking an operational perspective on due diligence provides deeper insights into the path of growth and direction of a target company. Understanding the operational drivers of the target company within competencies, capabilities, and efficiencies, including organizational structure and corporate culture, can equip you with essential data to determine the future profitability of your asset. So within the firm, when PE firms are too focused on making money through acquisitions only, they lose sight of their internal processes quite often. We've seen that with a number of our clients. And therefore, there's potential value that can be created from those operational improvements. I'm really thrilled to welcome both Samantha and Mike, who can provide front of the line context into the diligence process from this operational angle. And we encourage you to send in your questions as well as we move along, and glad to include them for the panel for both Samantha and Mike. But I'll start off with this question. Mike, perhaps you can take the first one. Can you describe the condition of the market and provide some context into the current state?
Happy to, and good afternoon, everybody. Pleasure to be here. David, I think you touched on this right at the very beginning, just about the intensity of deal volume. And if you were to have asked me a year ago what we could have expected in 2020 and 2021 as far as deal volume on the buyout stage, I don't think I would have bet on the kind of volume we've seen. A number of you have, I'm sure, have seen reports. There's a great study that Bain does every year on the state of the private equity buyout market. Encourage folks to pick that one up, but there's a few stats there that I'd like to share just to set the context. 2020, 600 billion in buyout deal volume alone, nearly 3,000 deals, and 3 trillion of dry powder looking for a place to earn a return. So I think we're familiar with those stats, but they are just reaching, they continue to climb. And that's converting into a really complicated and competitive environment for buyout shops like ours. You're seeing average multiples on US deals alone up at 11.5 times. And if you compare that to 5 years ago, it's materially increased. In Europe, 12.6 times. And it just is climbing through 2021. And a few things are behind that I'd offer. There's a lot of specialist funds coming in, David, where people are building funds that are either at the sector level or they're long hold, or they are co-investments. So you're getting a lot more players really keen to deploy capital. You're also getting SPACs, right? We talked about that, and I'm sure folks will talk about SPACs for a time to come. But there was a really interesting Economist article the other day that quoted that SPACs often bid 20 to 50% more for companies than a regular buyout shop might do, even the most aggressive assumptions. So you end up with players on the stage that are super keen to get capital to work. You're seeing their cost of capital lower than traditional players. You're seeing a ton of dry powder, and the net result of this is a competitive market, and leading businesses are commanding super high pricing, and they're getting it.
Yeah, I'd absolutely, sorry, David.
No, you go ahead, Samantha, please.
I'd absolutely agree with you, Mike. I think at the beginning of COVID, there was a lot of nervousness among advisory firms like ours about whether or not the M&A market was going to continue in the way we'd seen, and we've seen it not only continue but increase as both you, David, and you, Mike, have talked about. So I don't think that had an impact. I think that's kind of interesting when you think about, for example, maybe we'll get into this a little bit later, things like doing due diligence and site visits and all that sort of stuff. I think there was initially a view that, maybe we'll do stuff with teams we already know, but it'd be hard to do something new. And I think people got a lot more comfortable with that over the course of the pandemic because, frankly, they had no choice. I also think there's this really interesting prevalence of private equity that's kind of come up. If you go back to statistics of about, say in the 1990s, there were about 7,000 public companies and about 3,000 private equity backed or private, wealth backed companies. And those numbers have pretty much flipped. So now we have a really significant number of private equity backed companies and frankly, a less significant number of public companies, although that's changing. The IPO markets have been very robust lately. And you're seeing a lot more players coming into the marketplace. Mike talked about some of those. I think the other one we see a lot on my fund formation side of my practice is high net worth individuals and family offices, really putting significant amounts of money to work in this. And I think that stems from the fact that they saw these terrific returns people were getting from private equity and the opportunities private equity gets to invest in businesses. And they wanted to get in on that action. So they found ways to do that, whether that's because KKR and Blackstone went public or whether it's because they started putting family offices together where they could write pretty significant checks to some of these private equity funds. They found ways to get in there. And then the final thing I'd mention is we really can't talk about the market without talking about the availability and the cost of leverage. I mean, that really drives acquisitions in this marketplace for private equity, and the fact that we can still get very covenant light funding from banks. And frankly, when we talk about players, that has increased too. The number of private debt funds and other private lenders in the marketplace now compared to, even 5 years ago is significantly higher. And so there's just a lot of ability for people to find money to invest in companies. And so that makes the ability of doing these deals and chasing these good companies even more available to people.
I think to pile on there, Samantha, on the leverage point, one stat I saw is that 50% of deals are over 7 times levered. Right? So there is a ready source of leverage to allow these prices to continue to climb.
Yeah.
What an incredible shift from what we were thinking a year ago on all of this, and wondering when we would ever do due diligence again on some of these. Let me move on to another question, if I could, and Samantha, I'll start with you. So what are the implications of the pressure to compress the diligence process and streamline the deal-making process? I know you've experienced it, and we've chatted about it off camera as well.
Yeah, I mean, it's really fun to be a lawyer in this environment. Like lots of pressure on time periods and diligence. We'd like only a red flags due diligence report, but we need it done tomorrow. And of course, you have nothing else you're working on, right? Is sort of the typical call. So, and the customer's always right, so we try to manage that. I think the real advantages to sellers in this marketplace, I mean, they're able to, put forward, particularly a seller of what we'll call a good asset. If you have a robust company that's doing well and you're taking advantage of the fact that this is a good time to sell, maybe it's a little bit like the housing market, right? You can kind of ask for bids on a certain date. Sometimes people try and preempt the process by bidding outside the process and giving you an even better price. You can put together the information and kind of give as much or as little information as you like, because the process has become so compressed that people really don't have the time to do complete diligence. They don't have the time, or they don't want to spend the money to do everything that they need to do in order to give a price. And so they're putting an EOI, an expression of interest, or an LOI, a letter of intent, together, with some assumptions, but based on pretty good information. And then, once you've put that price in front of people, there's a lot of pressure, frankly, to stick with that price, because you probably won the deal because of the price, also because you're great to work with, especially if you're Mike at Omers. But if you're not, there's a lot of pressure not to kind of retrade. And even if you find something in diligence that's, somewhat significant, that you're always going to get accused of that. And so there's real pressure to put your best foot forward in this highly competitive market, put a good price on the table, and stick with that price. And so, you know, that's sort of the seller's market we're in. And I think that's a really challenging market to be in. And I'm sure Mike will talk about what it's like when you have to build in some of those assumptions, you know, as you go forward in the transaction. And in the transition of actually acquiring the company, it's very challenging.
And Mike, if you would first comment on the buyer's perspective, and then comment on sellers as well.
Yeah, on the buyer side, it's I think as Samantha, as you intimated there, we all know that it's the highest price that wins. And if I was to think back a while, we used to be looking at a business when we had more time to do due diligence. We would do our homework, we would understand the full potential, but we would keep in our back pocket a lot of the value upside that we saw. And now you have little choice but to, and we have these discussions regularly, how much of this do you price in? And you can only price those in if you have high confidence that that's the right play for you. And so the question that we always ask ourselves with every deal is, do we have a right to own this? And for us, that's a very helpful framing, because it sets up a whole series of questions about how deep are you in this sector? Do you know the 2 or 3 value drivers that have to be proven for you to really put some money behind this team? How well do you know the competitors that are bidding against you? Do they have deep sector expertise? Have they owned 3 of these platforms historically? We're even seeing some folks going back into the same deal that they owned 2 or 3 owners ago. So the implication on the buyer of this is you need to be deep, you need to be expert in your sector, and you need to get into a more operational mindset about really understanding the full potential of what you're buying. And David, I'm sure we're going to get here later, but it sets up this intensity of the process, really sets up what separates the winners from the losers, apart from the biggest price. For those who actually will deliver a return against it, is those that can get as much insight in 3 weeks as they might have done historically in 2 months. And I'm sure we can explore, David, what that feels like to do so, and we're happy to unpack that. From a seller's perspective, it's interesting because we've had some recent and current experience on the sell side, and as Samantha set up, it is to your advantage as the seller. And one of the ways that that's being expressed is sell-side diligence. And sell-side diligence for me years ago was never a high priority. Now you want to be able to you want to anticipate the questions that are going to be the needle movers, the decision makers for the buyer set. And you are curating and developing a pack that answers those directly in, of course, a favorable light. You want to be objective as appropriate, but I think you want to anticipate the questions that are going to be raised and package up the report.
And Mike, maybe I can just interject there for a second. You know, I think that's absolutely right that you want to put it the most favorable light, but I think it's also really important from the lawyer's perspective in particular. We're often brought in, you know, these are once in a lifetime transactions for this seller potentially on sell side mandates, and they're bringing in an expert like us who do this all the time, but we may not have worked with that company before. And so we're flying a little bit blind on the diligence side. We don't know where the issues are. And if we don't identify, you know, in addition to the favorable stuff, if we don't identify the unfavorable stuff, so maybe there's a IP license that's not exactly as you would like it to be, or maybe there's a piece of litigation that's, you know, you think buyers are going to be concerned about. You know, I can't stress enough how important it is to come at those issues directly and put your best foot forward on those difficult issues as well as the favorable ones, because you know, that's what derails transactions. Is first of all, if people feel like you're trying to hide something, like maybe they won't find this out. Well, I can tell you when you're going into transactions with private equity players, they'll find everything. You know, they do due diligence from top to bottom. They get Q of E, they have legal experts, they have financial experts, they have operational experts. So there's no point trying to hide something. It's just going to kind of come back to bite you in my view. What's much better is to spend the time with your advisors and internally crafting what your story is around that challenging experience. So whatever it is, there must be a reason you got comfortable with it, or there must be a reason you can put forward as to how this is not material or hurtful to your business. And you're better off to address that head on than to let it come out of the woodwork as part of the diligence process on the sell side.
Totally agree.
And it's interesting that how that time pressure has changed things. It wasn't so long ago when I remember people were doing sell-side diligence themselves, and the buyers were essentially pushing that to the side of their desk and saying, now we're going to do the real thing. And yet it's turned right around, as Samantha, as you mentioned, same as the housing market. You know, the diligence, the home inspections pre-done by the seller now, and to speed that up and create more competition. And with the lofty prices that we're seeing and the leverage we're seeing, there's a lot at risk as well. Certainly on the financial side of things, Mike, your organization's been very efficient at analyzing the financial side of things. On the operational side, and particularly of recent, where you haven't, in some cases, even been able to get on site with some of these, what kind of a challenge is that in the time frame that you've been dealing with?
Yeah, it's material, and it brings me back to the strategy of just looking at where you've made money in the past and doing more of the same. As simple as that sounds, because that way you go in. Like, we've done a lot of multi-site investments. We've had a great success in the healthcare space, in the pet space, in the physiotherapy space, etc. And going into a diligence saying, I have 3 questions, and here they are. But also having the internal benchmarks to know what good looks like. So it's hard to win as a novice in this market. So you got to pick your lane, you got to build the fact set, and that includes having the right people on the field. So we are adding in advisors to our group that can bring deep sector and functional expertise to the rock face in diligence. So that way, when you only have 3 hours with a management team, you are extracting every bit of insight you can. So ask yourself the question, what team am I going to put on the field for this asset? It's back to that framing of, do we have a right to win? And if you're new to the sector and you're just learning about those 3 questions, and your team isn't already looking around the corner for what this asset is going to face in 5-10 years time, then you have to really think about whether you want to be spending a ton of money and time in that pursuit.
Interesting. And Samantha, with this compressed time, have you seen the seller struggling with the speed with which deals happen? I know in the past it's always been the best pace was a pace that was quick enough to get the deal done in a reasonable time frame, but slow enough to allow the seller to come to grips with what the true price was going to be. Are you seeing pressures on that side as well?
Yeah, absolutely. Yeah, and I think it's a great point, and I think Mike will tell you this too. If this isn't a legal thing, but what people have to remember is once the sell side team starts working on the transaction, like, they actually have full-time jobs, they have to run a business. And the last thing you want to do while you're trying to sell a business is take your eye off that ball at all, right? So, the business is still operating in the background and metrics are coming in. And the last thing a buyer wants to see is that, oh, shoot, you're actually off plan for the month that we're working on this transaction instead of ahead of plan, and so forth. So, there's a lot of pressure on sell side businesses to really keep their eye on the ball. And how do you do that when all of your managerial time may be being spent on this transaction? And you may also be trying to keep it secret, right? You may not want to tell all your employees what's going on. And so, excuse me, you're involving a small team of people, therefore putting more pressure on them in terms of time. So we definitely see that. And I think that's where you go back to kind of having advisors and making sure you get the right team to help you through the process. Because I think if you overload yourself, you either don't answer questions well, you miss things, or you take your eye off the ball of your business. So, and I think for the advisors, we have to remember that even though this is my full-time job right now, trying to get your deal done, it's not the full-time job of my client, right? And we need to try to make things as easy as we can for them to get over the finish line. So I think that, to me, is one of the big things we see, and it does make it a very difficult process. And trying to make it as easy as possible. And that goes back to what Mike talked about, sell-side diligence and being well prepared in advance, so you're not scrambling. They are going to ask for copies of all your documents. And so, you know, if you realize you don't have leases that are fully signed, or you did that amendment and it's not in the document, you know, figure that out beforehand, because you are going to be asked those questions. And so there's kind of no point to waiting for the question to be asked. You may as well get organized ahead of time, and it'll make it a lot easier of a process as you go forward.
And we've seen that within our organization as well, and helping out some of the sellers in advance. I guess the housing market equivalent would be staging the but prettying it up and tidying it up and showing that there is more potential there. And maybe we can bring it back, Mike, to what you were talking on about, which is, you know, the benefit of an operational perspective when evaluating the deal, and how do you maximize deal value through the operational improvements?
Yeah, I think the greatest value of doing the operational daily as best as you can during the pursuit process is it gives you, at risk of stating the obvious, the confidence that you can back this management team and you can actually underwrite the value that you have to pay for this asset. And we find the homework done up front converts very efficiently into our value creation planning process. So to be specific, if you can see in diligence that there is a low-hanging fruit opportunity around procurement, you just know from your prior sector experience that if you think differently about the supply chain or about the network of partners, there's $15 million of EBITDA. Being able to price that in with confidence is a real leg up in the process, and you then roll that into your value creation planning process. Equally on top line growth, if you know in the past that if we introduce a new kind of enhanced plan or service to our customer set that we saw work in our prior asset, it hasn't been done in this asset. We know it's predictable, we know it can be done, and we know what the yield is. You test for the capability set of the target in diligence. Will it accept this kind of a lift in offering? Can they sustain that kind of a capability set? Good, 80% certainty, roll it into your bid price, keep a bit in your pocket if you can. But we find we go into our value creation planning process, and wherever we can, we are integrating and feathering into that what we learned in diligence. So the smarter on the way in, the smarter on the way out, out of the process, I mean, and being able to go across the table from management. And this is an important part we might come back to around just establishing your differentiation. Because during the process, if you can demonstrate to management that you are not just skating over the business, that you know what the value drivers are, you're investing the time to size them as best you can in diligence. Post-close, you're meeting them not as peers because you're new to the asset ostensibly, but credible. So they can look at you and say, this person I'm going to partner with will add value to my business because they know that there's a 15% pricing increase opportunity on this segment. They know that there's a diversification play into this end market. And you start out of the gate acting on those, and you don't spend 18 months learning about what the full potential of the business is. You come in with a clearer sense of full potential, and you'll miss things, and sure, the thinking will be incomplete. But doing operational daily, building that into your diligence plan against those 2 or 3 key variables, you'll be set up for a highly credible, highly effective value creation plan post-close.
Great points, great points. And Samantha, I assume that you come across examples as well where you have to coach the seller, for example, on, hey, make sure you get your own view of operational due diligence prior to the transaction really getting along the way and getting started.
Absolutely. I mean, I think there's so much that the seller can do, and you know, I find that the topic we're on now on management is so interesting too. There's a lot more you know, individual or personal connection to these deals than one might assume, you know, and I always find it quite interesting watching all the players. You know, sometimes we're on the sell side and we get to see auctions, so we get to see a number of different buy side players, and really everyone's kind of in the race. Mike's talking about trying to find a way to differentiate themselves. And one of the things we've seen in this competitive marketplace is some people really working hard at that, in terms of even things like saying to them, hey, if you don't want to sell even a majority stake right now, we'll take a minority stake and we'll work with you, and we think we're the right partner for you. You know, we've seen people looking at creative ways to try to get a foot in the door in particular companies or assets, or in particular places that they want to, because there's such a great you know, alignment there. And so I think we see lots of creative stuff going on that side as well. And just the whole kind of dynamics of working with people, and remembering you're working with people, you know, and not just treating this as kind of a balance sheet or those kinds of things. I think that EQ, you know, some of the private equity players have gotten a lot better at that, and I think it makes a big difference.
Yeah, a little story, if I can pick up on that one, Samantha. A little story we heard from an iBank that came and presented to our global internal offsite a few months ago. They shared a story where there was a private equity firm that they were advising bidding on a highly competitive asset. And management, even unintentionally, were dropping hints as to what was really on their mind. And they weren't necessarily in the pack, they weren't in the slide deck, they weren't called out in the diligence, but it mattered to them. And it was only this firm, this buyout firm, that picked up on those cues. And when the final presentation came, when the final bid went in their bid letter, it explicitly hit each one of those. And management said, holy cow, they really heard us. And that kind of EQ sensitivity, where you're looking beyond the deal dynamics into what's going to mobilize this management team, what's going to motivate them, how can we unlock their executive potential, let alone the potential of the business, can speak volumes.
Yeah, very interesting. Yeah. And now I'm assuming that for you, I know, Mike, you've also looked at add-ons and tuck-ins, and I know, Samantha, you've been very involved with them as well. How different is it on those? There's a different operational diligence because you have a different model and you're plugging them into a foundational organization.
If it's let's take it from a perspective of scale, and let's assume this is all post-close stuff. It's a different world when you're trying to bring in two platforms as part of an active process. But if it's post-close and it's a scale play that's transformational to your platform, then the diligence process, you often get more exclusivity and more time, because you know that this is a strategic target. You've spent time looking at the past. You've competed against them in the past. So the information asymmetry tends to balance a little bit more cleanly than in a competitive process outside in. It doesn't excuse one from doing the diligence that we talked about. In fact, you often have to do more because you're thinking about integration risk, which I think is a little bit different but incremental to acquisition risk. Because then you're talking about cultural distinctions, you're talking about team dynamics, you're talking about system integration. So there's a whole new set of questions that are critical to having confidence that you can then pull the trigger on that transformative acquisition. For tuck unders, David, I think if your platform is really good at this, M&A is a huge part of our thesis, and we love our businesses that have playbooks for these things. And they look at a tuck under, and again, they know the three questions, they know where the surprises are likely to be sitting, and they go after those, and they can get on these things so quickly and so efficiently and roll them in almost a weekend sometimes. So for smaller tuck unders, for me, the diligence is much more surgical, because you already believe the thesis, right? You already understand their role in the marketplace, and you already know what the value creation levers are. It's just about validating. So I think they're a bit different, but diligence remains a high priority on the operational side.
Yeah, I would totally agree with what Mike said. I think that I like the surgical comment. You know, people come to the table knowing better what they want to look at and what they don't want to look at, what's important and what isn't, and they've already got the operational expertise to look at. So, you know, I would say in a lot of tuck under acquisitions, the lawyers may actually do less diligence because they kind of, the operational team wants to look at some of the operational agreements themselves, right? They don't think of them as legal documents. They think of them more on the business side. And so, you know, that's a kind of different aspect to it. I think it can be harder on the people side, the tuck under. You know, we talked about the management, kind of getting the management on your side and listening to them. You know, the problem on the tuck under and the strategic acquisition is they might be going out the side door after the deal, right? So that can be difficult to manage. You know, the businesses don't need two CEOs, and so you know, if there's a CEO of your tuck under and you already have a CEO, you know, that person probably knows they're out of a job as part of the transaction. And so if it's a competitive process, that can be an interesting dynamic. Trying to figure out how to manage that. Of course, in some processes, that's terrific, right? They're ready for retirement. This is a succession plan, and it's exactly what they want, and they couldn't be happier. But that's not always the case, and so that I think can definitely cause some challenges on tuck unders. And you know, I think the other thing, as Mike talked about as well, is we often don't see the tuck under transactions or the more strategic transactions on a competitive basis. They might be, you might be getting a first look. I don't think it takes, frankly, much of the pressure off on the pricing side, because you know, you're not going to get the deal unless you're really stretching to pay top dollar, because they're going to go to a process if they can't come to an agreement with you. But it does kind of make a little more breathing room, and you can probably ask a few more questions and get a bit more information. And so, you know, it tends to be a bit more of a, I don't know, scheduled process, a little less frenetic. So
to build again on this one of the elements that is becoming more clear in my mind is the need to do diligence on yourself as the acquiring platform, to see how ready you are to absorb the asset that you're pursuing. And a specific example is the cultural side of it, Samantha, that you touched on. And a lot of our companies are very keen, appropriately, to buy new capabilities, new strategic value opportunities, and these companies can feel different than the core platform. They can be more innovative, they can be more cutting edge, and the culture that leadership team will represent feels different often than the culture of the platform that's doing the acquisition. So when you look at the crown jewels you're buying, if it is the management team and their developers, etc., you have to ask yourself the question, what's our track record at absorbing teams that feel different than we do? And if you integrate them, great, you get the scale, you put the people in the boxes in the platform, and all of a sudden the magic is gone and you've lost the value of that asset. Recognize that that's a risk and ask yourself that question, you know, how do we protect the cultural subtleties, the magic, that mojo of the asset? How do we protect that when we bring it into our platform? Because if you don't think that through, you might find yourselves with EBITDA that's declining, and you haven't got the benefit of the you know, those subtler things.
You know, that reminds me of a number of organizations we've worked with where they've thought through some of the critical areas. Maybe it's their go-to-market strategy, or how they're going to get synergies out of financial or sales areas. But when they look at the core areas of the business, particularly as you get further to the back office, we're going into organizations that often it's, you know, up to a couple of years after post-merger, that they still have their own systems. They still have their own methodologies on, you know, running their more manual aspects of reporting and financials. And it's an incredible miss by the organization, because when you get to those things and you streamline them, it helps the downstream areas of the business. It helps those market synergies, and it helps streamline the sales processes as well.
And I think this is especially a risk in this kind of frantic seller side market, you know, because I think there's a lot of pressure to do deals, and you know, you see these large companies that are doing serial acquisitions, and then the transition and the integration part can be really challenging. You know, some of them are trying to, they're just trying to get acquisitions on tap, and they're doing another one and another one, and all of a sudden you've done 10 acquisitions in a year, and you can imagine what that does. You know, what is our culture even at that point? So it's, these things can be really tough in a frantic market like we're having right now. You know, when people are kind of always looking on to the next deal and not necessarily looking backwards to make sure that the deal we did is you know, coming on stream the way we expected.
Yeah, we've walked away from opportunities that on surface looked fantastic, but then you realize that they've been bulking up at a frenetic pace, and the assets are not integrated, and it's going to be on your watch to figure this out. And during diligence, you just don't have the luxury of time to sit down with the regional GM and say, tell me about how the systems are integrated with these last 3 acquisitions. You just don't get that access. So it's buyer beware. Samantha, that's a huge point on what is the composition of the platform that you're buying, and how coherent is it? And that's often hard to diligence on the way in, but it's such a watch in this market.
Well, let's carry on that vein. So, Samantha, have PE firms' priorities changed in your view, and how can firms optimize operations to enable those new goals?
Yeah, I think there's been some interesting shifts in, I mean, we could talk generally about transactions. You know, we've definitely gone from years ago, you know, more manufacturing-based businesses to much more tech-oriented businesses, and you know what goes with that in terms of, like, I rarely, obviously leaving retail aside, I rarely see transactions where the real estate component is even a sort of interesting component of the transaction. Most of the time it's leased premises, and you know, frankly, I would say I see more deals where people don't even bother getting landlord consents, because what's the landlord going to say? You know, like, are they going to kick you out when you're paying your rent and so forth? So it's that's quite an interesting shift from, you know, where things used to be, where we might spend a lot more time on diligence, and we certainly would if there were owned real properties. So that's a whole other, but that's pretty rare. I mean, I think the places where we see on the diligence side in particular more focus are talent. So, you know, the people, and, you know, some very interesting to me, and a little bit along the lines of some of what we're talking about, people are actually doing psychological profiling and things like that, like really understanding the team and the team dynamics and how the team is going to fit with your existing team, if that's the case of for a tuck under, or how it works generally as a team right now. Technology is huge, right? IP, IT, cyber. I mean, we spend a lot of time, and you know, we've been bulking up our expertise in all of those areas, and each deal we do, there's a whole lot of time spent on that, and you know, on potentially getting very specific diligence depending on the kinds of, you know, for example, on open source or other types of IP concerns, and it's very there's a lot of time spent on that. And then I guess the other one we see more recently is this whole focus on ESG, you know, where people are doing things, how people are doing things, a lot more concern about understanding sort of the very, you know, bottom line of where things are going, and where they're coming from, and if people are keeping this in mind and how they're keeping this in mind, and so forth. I mean, that we're seeing that permeate in lots of different areas. I mean, you'll even see it from a board composition standpoint. I mean, look at some of the Blackstones, State Streets, et cetera, who've come out around term limits, around female board representation, around diversity in the boardroom. You know, it started there, and of course it permeates all through the operational side of the business as well. And so I guess those are the few things I would touch on that we see kind of increased focus on the diligence side from our perspective.
Yeah, I would double click on the tech point, Samantha, and that's, if I was to look back 5 years ago, where the tech diligence, it wasn't just an inventory of systems and platforms and how many licenses they had and whether it's out of code and that kind of stuff. Now we're spending so much more time on the tech dilly because every business is essentially a tech business, and the connection, the interdependence of the tech as an enabler of the growth thesis is really the center of how we design our tech diligence. So if we want to build a business from X to Y, what are the technology enablers? And it touches everything from the processes and the tools to data and privacy and the ability to get insight into your pricing dynamics. Like all of that for us fits into that new tech dilly box. And we've looked at we're now using different partners to help us on our diligence over time, because ask yourself the question, is your tech partner for diligence thinking about things progressively? Are they thinking about the connection between technology as an enabler of growth, not just technology in its own right?
We recently came across a finding that private equity firms are delaying their announced takeover until after they've had a chance to enhance the cybersecurity of the target company before announcing the deal, because they feel that that's their most vulnerable period of time of cyber attack, after they've acquired it, before they've fixed it.
Hadn't heard that. Not surprised. That actually makes sense.
Yeah, interesting dynamic. We have a question from the audience, actually. How do you think the market will progress in the future? So you get to pull out your crystal balls now. And do you see it as being a buyer's market anytime soon? And how will this affect due diligence process?
Now you get to hear about whether we're optimists or pessimists. I tend to be an optimist by nature, but I guess I'd say a couple things. For me, I mean, if you look back at the last time, you know, Mike and I went to school together, so I know how old Mike is. So he and I are old enough to have been through a couple of these cycles. And in the last financial crisis, 2008, 2009, you know, what happened? Well, the leverage market dried up, right? Like we literally went kind of overnight from, and in fact, I think Steichmann's may have worked on one of the last deals that got done that where the bank had difficulty getting other partners on its lending side, and that's kind of what shut the lending markets down. And so, you know, I think people learned their lessons in 2008 and 2009, because I think, you know, they ended up being out of the market, and we talked about the new players on the debt side coming in, and you know, that really grew out of that problem. But you know, I think as long as leverage continues to be available on what I'll call covenant light or covenant non-existent terms, you know, that's gonna continue to drive the market. And Mike talked off the top about the dry powder that's in the marketplace and how much desire there is for this. So, you know, those are the things that I worry about. I guess I'd make two other comments. One is I worry about inflation. I worry about, we're seeing supplies that are expensive. We're seeing employment shortages, talent shortages. That usually leads to price increases and usually leads to then interest rates and so forth. So not only the inability to get leverage, but also if leverage becomes more expensive, I think that's going to definitely have an impact. So those are my sort of pessimistic side. I guess my optimistic side would say, I think it's kind of interesting to see what's happened with COVID and with potentially a more significant focus on less globalization, if I can put it that way. If we look at what happened with PPE and vaccines and the fact that those countries that had their ability to produce these things themselves, as opposed to rely on contracts with a third party in another country, you know, that turned out to be a real advantage. And I think that is going to, you know, we might see a deglobalization trend. If I were making a prediction, you know, we act for a company called Dr. Oetker. They, as you know, make pizza, and they happen to have constructed a pizza plant in Leamington, Ontario, about 5 years before the crisis, so not having anything to do with it, but they were super thankful that they'd done that during this, because you can imagine that trying to deliver frozen pizza over the border from the US in the context, and apparently frozen pizza was one of the things everyone was buying. My freezer was certainly full of it. So, but you know, little things like that, like it wouldn't surprise me if we start to see more domestic focus on domestic capacity, where we're doing manufacturing more locally, and on things like, you know, PPE, vaccines, other sort of what one might think of as essential services. So those are my predictions. We'll see what happens.
I see the dynamics continuing, frankly, with the dry powder point, the fact that the cost of capital for some of these new entrants is lower. Mm-hmm. You're seeing a blending, you're seeing a converging of traditional silos of private equity. If you think about the broader definition of infra versus buyout versus growth versus venture, you're starting to see a compression where you get buyout shops that are now accepting 12, 14% returns, not 20, 25% returns. So I think there's going to be pressure on the underwritten case. You're going to still see pressure on the multiples to climb. And what's an interesting sort of internal story is, forever when we model an opportunity, we have to model, of course, the going in multiple and the potential exit multiple. And we've historically modeled in a compression on that multiple coming out. And that affects your ability to compete on that certain pricing you're prepared to pay. And we increasingly ask ourselves, there's no evidence. Where is the evidence that the multiples are going to compress? So consider that as you think about your modeling. The only other point I'd mention is, there is always going to be a buyer's market in certain zones of opportunity. I think about the tuck under space that we play in with our platforms. And if you have the right team with the right playbook and you know exactly what you're solving for from a market opportunity, you can still find the multiple arb. You can still find a target at 6, 8 times, and your platform's at 12, 14, 18 times. So there will be buyer's markets. They may increasingly be picked over. That just comes right back to, do you have the right team with the right capabilities to bring something in with a little bit of hair on it and still get the value at the other side?
Yeah, and I think it's a great point, Mike. I also think the creativity we see among these private equity groups, and Mike just touched on this, you know, the fact that they're willing to do, you know, different kinds of transactions. And I don't think they're doing different transactions in terms of, I think they're still focusing on their wheelhouse and all that sort of stuff. But now they're sort of saying, well, if I can't compete at this level of buying the company that has 100 million of EBITDA, can I go down to the $25 million EBITDA company, and can I do some tuck unders at that level? Because it only takes maybe 2 or 3 of those companies, which are probably achievable at a smaller multiple, for me to then build that $100 million company that I was looking for. And so we're seeing, you know, to your point, Mike, about the blending of the lines a little bit, or blurring of the lines a little bit. We're seeing people who used to be solely buyout shops now becoming venture investors, or becoming, you know, thinking about taking minority interests, or doing different kinds of transactions to bring value. And I think for the sellers, you know, when you have these people who have incredible expertise, I mean, I don't think we should also undersell the fact that these private equity shops are, you know, well-oiled machines, and they're excellent at what they do. They're excellent at helping people, you know, figure out process improvements and figure out better ways to do what they're doing with the supply chain, with the customer chain, whatever it is, with technology, with their back office. And so, you know, this really is often an opportunity on the sell side for somebody to, you know, they still get a piece of the action going forward, because that's also how private equity works. And they really get this amazing advice to take them to that next level that maybe they don't feel they're capable of doing without that kind of backing, right? And so that's the secret sauce.
Yep, well put.
And one of the questions from the audience that came in is, you know, do your comments apply to both large scale and small mid-market transactions the same, or are they different?
I mean, I think from a diligence perspective, they're the same. I often talk to my associates about the fact that the diligence on smaller transactions is actually harder than the diligence on larger transactions. So if we think about the giant deals we read about in the paper, you know, they're often PE to PE transactions, right? Like some fund is at the end of their life, they're ready to get out of this, or they're moving on to, they're focusing on a different area, whatever it is, they're getting out. You know, these companies that, for example, an OMERS has been involved in, you know, the diligence is relatively easy. You know, they're not missing documents, and their IP rights are all, that's all been cleaned up, right? Like the big issues, private equity players don't do well with those kind of issues, right? They're going to have already solved most of those issues. And so while the diligence is still super important, the things you're going to find, in my experience, are much fewer and further between. Whereas on the small transactions, you know, a lot of times there's, you know, the materiality threshold's way lower, and frankly, you know, they haven't been professionalized in the same way. You know, not to criticize at all, but just, you know, you're not using the same kind of advisors, you're not using the same kind of lens to look at things. And so, you know, we see, frankly, often a lot more issues. And that goes to that pricing we talked about, right? Like, that's why they're 6 to 8 times instead of 12 to 14 times, right? They aren't at that stage yet. They haven't, maybe they don't even have the negotiating power with the suppliers, for example. It's not necessarily a mistake anyone's made. It's just a matter of where you sit in the marketplace.
All I would add, David, is for the large end of the deals, your focus may turn more towards the growth potential that remains. You know, we always look at TAM and share and stuff for any asset, but we don't play in the mega end. But I would imagine that you're going to ask yourself, can we underwrite a growth rate that's more than low single digits? And if you're happy with that and your cost of capital will support that, giddy up, right? But if you're moving into that zone, but you have an expectation and your shareholders have an expectation of 15% return, then your burden of proof around the growth potential might be even higher on the big end.
Great point. So we're getting very near wrap up. I'd ask each of you, and we'll start with you, Samantha, your final thoughts and maybe top key takeaway that you would give the audience from today.
Yeah, I mean, I hope this has been interesting. I think the operational side of diligence and the importance of diligence is hopefully one of the key takeaways, certainly from my perspective. You know, understanding the kind of business side of things. And if I can speak, you know, from an advisor perspective, you know, we often focus on risk and on the few things that are material to the business from a legal perspective. But what I find so interesting are some of the softer things we've spoken about. So first of all, the operational, you know, thinking about the business as a whole. And I think as you get more senior in this role, you get more of an opportunity to play in that area and in those discussions. And I know, David, you get that opportunity with what you do as well. And it's really interesting and can really drive some of the other parts of the deal. So understanding that, I think, can be very helpful. And then the culture side that we talked about, I think is a lot more important than people may realize. And so, you know, being good listeners, being attuned to the culture, particularly in a competitive marketplace, I think can be a real differentiator. And I think that's a nice little secret ingredient.
Yeah. Well, what I would add is before, as a buyout team, before you leap into the Thunderdome of the deal, ask yourself the question, you know, what is your right to win this asset? And then look inside and ask yourself, are we set up to run as hard as we can and win? And those are questions around, do we know the top 3 value drivers for this asset? What historical precedents and data can we bring to bear to make us faster, smarter, more quickly? But equally, are we set up internally to make a fast go, no-go decision? Do we have the right people on the field? Are we aligned with our internal decision makers so that we don't find ourselves at the 11th hour with misset expectations? Because when you're hopping into Thunderdome, you have to be so lined up where you can't be wondering whether you're prepared to win. You have to be convinced. It's all about conviction. Are you convicted? Do you have the conviction you're going to win, and are you tooled up to do so? Would be what I would add.
Great advice from both of you. Samantha, Mike, thank you so much for joining me today and joining TPG, and for the audience as well. Thank you for joining us, and we encourage you to check out the PoirierGroup.com website and look us up on LinkedIn and follow us for more information and news coming forward. Thank you once again, everybody.
Thanks, everyone. Have a nice day.
Bye, guys.